we found an unusual trade worth $736 million on Centene stock, ticker symbol CNC, that was being done on the last trading day when the stock dropped to a new low. And what's also very unusual about this is that Centene reports earnings at the end of this week on October 25th, in just a few days. And so in this video, we will analyze this unusual option activity to find out how wealthy investors are now trading Centene. Are they bullish and buying, or bearish and selling, so that we can also make the same financial decision to make money while the rich are getting richer on Wall Street? Because as we all know, the rich have more access to information, including leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. Now, if you're not familiar with what's going on with Centene, you can see that it recently dropped down considerably. Quite a crash down on October 17th. And this happened, as you can see here, because other companies in the health insurance sector have been reporting earnings misses and soft guidance. And so there is a sell-off for a lot of these health insurance companies, such as Centene. And that is why the stock went down in its largest percent decrease. And so a lot of investors who are in the stock are panicking and selling. But could this actually be a buying opportunity? Well, let's take a look at the data on how this wealthy investor is trading. So without further ado, let's dive in. As we can see here on the options time and sales tape, on the last trading day, October 21st, at the same time at 1:56 at the 19-second mark, we can see these December 20 options, 122,800 contracts and 103,700 contracts being traded for these 60 strike puts and these 65 strike calls. And based on our analysis of these two options for the December 20s, you can see here that we believe they are selling these 60 strike puts, and that is why we have the same position here. POS stands for position, red means sell, and they were buying these 65 strike calls, and that is why we also have that position here. Green means buying. And so when we analyze this trade, buying these 65 strike calls, selling these 60 strike puts, on the risk profile profit loss graph, we can see here that the share price on the x-axis here and the profit loss on the y-axis here, as the share price goes up, you can see this becomes more positive profitable. And if it goes down, it becomes more negative loss, because this is a long bullish trade. But keep in mind, they are hedged on this trade, and that is why you can see that this blue line is flat all the way to the 60 strike puts that they sold as a cash secured put strategy. And what this means is that they were willing to own 100 shares at this strike price of $60 a share. And so each of these put options that they sold required $6,000. And since there was a total of 122,800 contracts, we multiply that out and we get a total trade that required $736 million. But keep in mind, this is still a higher risk trade because earnings is coming up in just a few days. And this trade is well hedged, because if it goes down, it is still going to be profitable at expiration, because this blue line at expiration is above the zero line. It's a trade that has a positive credit. So be aware of the higher risk of this trade in comparison to the trades that we share on our website. If you are interested in lower risk, higher probability of profit trades based on stronger data analysis than this one right here, then make sure to go to our website. We'll put a link at the top here where you can gain access to better trade ideas that have a higher chance of success. Now, some other things to note about this trade is that the ratio on this trade is actually different. You can see here that the puts is at 122,800 contracts. This is a different ratio than the call options at 103,700. And so we can find out more details about this wealthy investor's trade because we have the price that they traded these options at. And so if we start with the call options at 240, we need to multiply by 100 since each option represents 100 shares of stock. And so each of these call options cost $240. And since there was a total of 103,700 contracts, we multiply that out and we get a debit of $24,888,000. And so keep that in mind. And now let's calculate the puts that they sold. So the price was $292. We multiply by 100 since each option represents 100 shares of stock. And so each of these put options that they sold, they collected a premium of $292 of credit. And since there was 122,800 contracts, we multiply that out. And so they received a total credit of $35,857,600. And so we need to subtract out the debit that they paid for those call options, which is $24,888,000. And we get a net credit of $10,969,600. And so if we analyze this trade some more on these options here, at the correct ratio of the 122,800 contracts that they sold these put options and buying the 65 strike calls, 103,700 contracts, they had a net credit of $10,960,000. And so when we analyze this trade, you can see here that their trade here, which has a credit of 10 million, is still profitable all the way here where the zero break-even line meets. So everything above this share price of about $59 is still profitable at expiration, which shows up over here in this box on the blue line. Okay, it's all positive here. This is how much they could be gaining. So even if the stock stays where it currently is, they will be able to make a profit of $10 million on December 20. So keep that in mind with this trade here, where they don't necessarily need the stock to go up after earnings. As long as it doesn't drop below $59 a share, where you can see here that on the blue line, it is still positive. Only when it starts to drop below $59, it becomes a negative loss. And so that is why this trade is higher risk. Now, another thing to keep in mind is that when we take a look at whether or not these trades were closing or opening trades, we can look at the historical data here. When these trades were made on October 21st, we can see here that for these December 20 options at the 60 strike puts, the volume 125,000 and the open interest was only 85. And the 65 strike calls, we have the volume being traded much greater than the open interest of just 66. And so if those trades that they made were opening trades instead of closing trades, because we only want to follow opening trades, not when wealthy investors close out of their trades. We use that type of data to decide when we take profits or manage our trades. But to open new trades, we want to follow opening trades. And for this to be confirmed an opening trade, we need to make sure that the open interest has now added for the new data. And you can see here that at the 60 strike puts, the open interest has now added, and at the 65 strike calls as well. So both of these options are confirmed new opening trades by this wealthy investor. And so that is why we followed this trade. But keep in mind, the way we followed it does require selling a 60 strike put, which is $6,000 of buying power. And so if you want to learn how to use different strategies so that you don't have to spend so much on each of these trades, then make sure to go to our website we share our option strategies, not simply following the trades of wealthy investors, but we analyze whether or not they are going bullish or bearish, and then we set up option strategies that require less capital to trade in that same direction. Let us know in the comments below. Do you think it is a good buying opportunity for Centene stock? Or will it continue to crash down lower and make lower lows? As usual, please smash the like button, subscribe if you haven't. Take care and have a wonderful day.